Okay, so hello everyone, and first let me just say I'm really sorry that this is going to be the last video that I'm going to do. Before my Retail Rebellion weekend live online event, so be sure to grab your free ticket by clicking on the link in the registration box below, because all the best stuff I'm going to save for this coming weekend. Very often hear people comment that I'm staying out of the US market or I'm selling my US stocks because it's just too expensive. It's a bubble. And who can blame them? Because that is what the media tends to push as a narrative very often, especially recently again. If you look at some of the headlines, it's a super bubble in the US stocks about to pop. Economists who called the '08 recession warned stocks in a mega bubble. .com prophet Albert Edwards, who predicted the 2000 crash, warns another bubble is going to burst. Huge growth stock bubble could sink the S&P 500 by 40%, says Bank of America. Interesting thing is that I've been in the markets now for over 25 years and they've been saying this same shit for the last 25 years. Every year they tell you the market's in a bubble. What's new? Okay? And I'm just going to give you a couple of examples. If I show you every single year, it's going to take a few hours just for this video, but just a few examples. So this is the S&P 500 US market for the last 16 years or so, right? Since 2008, 2009. And you can see, for example, back in 2010, there's a big article by the New York Times that says that the market forecast that says, take cover, markets are in a huge bubble. Robert Preacher, the market forecaster, said that we are entering a market decline of the biggest in the last 300 years. So this was in 2010. This was like 15 years ago. There's a bubble, it's going to be the biggest crash in 300 years, right? And then in 2014, Goldman Sachs at the time said the last time stocks were this expensive was the tech bubble they warned. So again, they say it's a bubble over here. And then back in 2017, Harry Dent said once in a lifetime crash is coming in the next 3 years. Did it come? Not really, right? And then over here, July 2020, as the market was recovering, the Financial Times said the coming earnings season could bring lofty stocks down to earth. So again, they say the stocks are too expensive, it's a bubble. And then over here, we have got our good friend Robert Kiyosaki. By the way, not all Asians are the same. Let me just warn you that, right? Do you have a plan B? We are in the biggest bubble in world history. This was back in March 2022. And then over here, in April 2023, we've got Harry Dent again, the same guy that said that he had a once-in-a-lifetime crash back in 2017. Now he says, I expect another crash in our lifetime between now and June in 2023. So my question is, how many lifetimes does this guy have? I mean, is he a freaking cat? All right? Does he have like 9 lifetimes? I don't know, right? And then again, recently in 2024, we have got Kiyosaki again says, the everything bubble, stocks, bonds, are all going to crash, we're going to die, right? So every year they tell you that stocks are too expensive, I've heard the same story for 25 years. As you guys know, I don't make my decision based on narratives and news headlines. I make my decisions based on numbers. I'm a numbers guy. I like to look at numbers, right? And if the numbers tell me the market is expensive, sure, I'm going to get out right now. I'm going to sell, right? But if the numbers tell me that the market is not expensive, I'm going to keep buying. So it's all about the numbers. So why do some people say that the market's too expensive? Well, it depends on what metrics you look at. Now, some people, they love to quote this thing called the Buffett indicator. And they said that the Buffett indicator shows that the market is too expensive. Now, what is this Buffett indicator? Well, many years ago, like 30 years, 40 years ago, Warren Buffett said that he looks at the market cap of the S&P 500, which basically means the market value of the 500 stocks in the S&P, and you divide that by the US GDP. And he said that this should be below 100%. If it goes above 100%, then it's going to be very expensive. And recently, this indicator has hit over 200%. And there are a lot of news headlines that say, oh, the Buffett indicator says that it's a super bubble, right? And it hit 205%, signaling extreme market overvaluation. So is this a reliable indicator? Well, if you do your research, the answer is no. In fact, very recently, someone asked Buffett about this indicator and he said, well, I don't use it anymore. It used to work, it doesn't work anymore. Why? Very simple. 30, 40 years ago, this indicator worked because the majority of the profits that came from the S&P 500 were from the US market. But as you know, increasingly, many of the S&P 500 companies are multinational companies. So a bigger proportion of their profits, in fact, some companies, 25 or even 50% of their profits are not from the US market. They are from all around the world. And all these profits that they make from all around the world is not captured within the US GDP. You get the point? So now the S&P 500, the market value has gone up because it makes a lot of profits like Nvidia and Microsoft and Apple. But a lot of their profits are not from the US economy. They're from outside the US economy. So this is increasing, but it's not reflected in the US GDP. Hence, the indicator looks very high, but in actual fact, many of these companies are not expensive. Another reason why some people say that US stocks are expensive is because they're looking at the PE ratio of the entire market, the price to earnings ratio. More specifically, let's take a look at the price divided by the forward earnings ratio, which is the share price today divided by the projected earnings of the companies over the next 12 months. So you can see that right now the forward PE ratio of the S&P 500 is 22 times earnings. So is that high or is that low? One way to judge is to compare it with where it was historically. So if you take a look at the last 10 years, the average forward price to earnings ratio of the S&P 500 was 18.4 times over the last 10-year average, and the last 5-year average was 19.9 times. So currently, is it above it? Yes, it is above the 5-year and 10-year average. So does this show that stocks are expensive? Yes, if you look at this metric alone. However, I've mentioned many times that PE ratio by itself is very misleading. Why? Because it does not take into account the growth of the earnings, right? It does not take into account the growth of the earnings. So one thing to understand is that the companies today, their earnings are growing much faster than they were 5, 10, 20 years ago. And the profit margins of the companies are 3 times more today than they were 20 years ago. So you can't compare today's PE ratio with the historical PE ratio because companies are growing faster with higher profit margins. So a more fair comparison is to use what we call the PEG ratio. So what is PEG ratio? PEG ratio is the PE ratio of the market, or you can use a stock if you want, divided by the earnings growth rate. Okay. So remember that a stock with a high PE ratio can be cheap if the earnings are growing double digit. Then it's actually very cheap. Like Nvidia used to have a very high PE ratio, but because the earnings are growing very much, Nvidia was actually very cheap. That's why I bought Nvidia at $15 in 2022 when the PE ratio was 60 times earnings. People thought it was expensive. It was actually very cheap. And from $15 a share, Nvidia is now $160 per share. All right. But a stock with a low PE ratio, like Intel, looks like a low PE, could actually be expensive because the earnings are not growing. The earnings are declining. Okay, so you have to always judge the PE ratio in relation to the earnings growth. And one way to do it is to look at what we call the PEG ratio. So basically, the higher the PEG ratio, the more expensive. The lower the PEG ratio, the cheaper. So what's the PEG ratio of the market today? If you take the PE ratio, divide by the growth of the earnings of the companies, well, you get about 1.4 something, roughly about almost 1.5. So is this high or low? Well, again, if you compare it to the recent history, it is not low, but it's not very high as well. In fact, you can see the PEG ratio of the S&P 500 was at 2.0 back in 2023 or so, right? It was at over 2.4 back in 2020. It was 1.7 in 2016. And you can see over here in 2010, in 2004, in the 90s, it was higher than where it is today. So if you actually take the PEG ratio, which is a better valuation measure, the market is cheaper today than it has been many times in the last 30 years. I can tell you that if you really want to know whether stocks are cheap or expensive, forget looking at the PE ratio, forget the Buffett indicator, forget the PEG ratio, because all these are just too general and they're just too vague. So let me give you an example. If you just take a look at the GDP per capita of the US, you may conclude that, oh, all Americans are rich. or if you look at the GDP ratio of Singapore, you may say, hey, all Singaporeans are rich. Is that true? Of course not, right? It depends on, in the US, which city. Certain cities are richer than others, depends on the household. So to really get a picture of whether stocks are cheap or expensive, you have to look at the individual companies and do a valuation of the individual companies using a discounted free cash flow valuation model, or price to book ratio, or price to or discounted net income valuation method. So that's what we do at Piranha Profits. We drill down to the individual companies. We do a bottom-up approach to find out, yes, in the market, which are the expensive stocks, which are the cheap stocks, and are they more expensive, more cheap, and how do we focus on the ones that are fairly priced or undervalued, the high quality stocks. Okay. So we have just used Stock Oracle to run through all the 500 stocks in the S&P 500, and what we found is that out of the 500 stocks, yes, there are some that are very expensive. In fact, out of the 500 companies, 155 companies are more than 20% overvalued. So that makes up about 31% of the stocks are very expensive. So obviously you don't want to buy these stocks. Well, not yet, until they come down, right? And about 12.4% or 62 stocks are overvalued by more than 10% to 20%. But again, in the market, you do have stocks that are fairly priced. Not too expensive, not too cheap, fairly priced within plus minus 10% of their intrinsic value. And this would be 161 stocks in the S&P 500. And lo and behold, there are stocks that are still cheap. In fact, you can see that about 10.4% of stocks in the S&P are undervalued, between 10 to 20% below the intrinsic value, and 14% of stocks are very undervalued by more than 20%. So you never make a sweeping statement that all stocks are expensive in the US. No, you've got cheap, you've got expensive, right? The key is, how do you focus on the ones that are cheap and not too expensive, and add the high quality ones and avoid the expensive ones? What are some of these specific stocks that are good quality companies that are fairly priced or underpriced? Well, if you want to find out, what you have to do, that's right, you have to join me at Retail Rebellion, my upcoming live online event. It's going to span over 2 weekends. I'm going to start speaking this weekend, and it's a free ticket. You can claim a free ticket. You can register by clicking on the link at the description box below, and I'll see you guys this weekend. Okay, but don't worry, let me just, give you some ideas. Okay, so again, I'm going to show you this entire list during Retail Rebellion, but for now, I'm going to, tease you a bit with some stocks. So you can see, for example, KLA Corporation, which is really expensive right now. You've got Walmart, that is pretty expensive as well. You've got Broadcom, a great company that is expensive as well. American Express, also very expensive. So these are highly overpriced. Then you've got stocks that are overvalued between 10 to 20%. For example, you've got stocks like CBOE, which is the options exchange. You have got stocks like, let's see, Synopsys, and a couple of others over here. And then stocks that are fairly valued between plus minus 10%, stocks like AMD, you've got Amazon, you've got Arista Networks, you have got Electronic Arts, you have got Coca-Cola, you've got Lowe's, and a couple of others. And stocks which are undervalued, like PayPal, like Pfizer, like Pepsi, like Pool Corporation, like T. Rowe Price, and Salesforce, also undervalued between 10 to 20%. And then stocks that are very cheap right now, like Lululemon, and you've got CarMax, you've got Kraft Heinz, and you've got BDX as well. Now again, bear in mind, I keep saying that just because a stock is cheap doesn't mean that it's a good investment. It has to be a high quality stock that is undervalued, right? So you have to look at the quality as well. And that's what I'm going to show you in my webinar during Retail Rebellion. What is my checklist of how I identify the highest quality companies, the companies that have got consistent growth in revenue, profits, free cash flow, companies that have got strong economic moats, companies that I know may drop temporarily, but they will always bounce back higher. We call this the tennis ball stocks. But some stocks I call the egg stocks, right? They drop, they don't bounce back. Some of them may even crack if they drop too hard. So look forward to seeing you there again this weekend at Retail Rebellion. Go to the description box below this video, click on the link to grab your free ticket, and I'll see you soon. May the markets be with you.